Welcome to the Advisory Group's Managing Your Wealth in 2025 workshop. Let's first start with some introductions. My name is William Glenn, and I'm a Client Services Associate as one of our TAG team members. Also joining me today are Brent Beverly, the President of the Advisory Group, and Manny Chinche, a Senior Advisor at the Advisory Group. Both of them, as well as Chris Lee, Vice President of the Advisory Group, are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. Before we begin, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will be focused on investment planning and equity markets, and we will also share with you some proactive tax planning strategies. Let me bring up Manny Chinche to get us started. Manny?
Thank you, Will. After a strong year in 2023, many analysts felt that 2024 was going to be a difficult year for investors. Heading into the year, they forecasted a fair amount of uncertainty, including a very controversial and highly heated presidential election and unrest in Europe and in the Middle East. When 2024 ended, it was another good year for investors. Equity markets made multiple new highs, and disciplined long-term investors were rewarded for a second consecutive year. As you can see by this chart, although in 2024 the markets finished considerably higher than where they started, they clearly did not move in a straight line. Investors saw markets retreat in April, August, September, and November, and even December. It was worth noting, however, that those who stayed the course in 2024 were rewarded. For the second straight year, the S&P 500 finished the year with a gain of more than 20%, while the Dow Jones Industrial Average ended the year at more than 13%. For 2025, volatility has returned to the equity markets, but January was an advancing month. Through mid-February, year-to-date, the S&P 500 index is positive for the year. Now let's take a brief look back at some highlights from 2024. As mentioned, 2024 was a good year for investors, and we just showed 2025 has started an upward movement. Inflation continued to move closer to the Fed's goal of 2%, but is still elevated. In September, the Fed made the first of 3 straight interest rate cuts to end 2024, and that brought a sigh of relief for many investors. Many of the key indicators that economists watch for remained healthy during 2024, and volatility returned in a strong way, especially in the last 2 months of 2024, and continues to remain. Because of this, please remember a well-balanced portfolio should be designed to include proper diversification to address times of volatility. So overall, 2024 was a good year for investors, and 2025 has already started on a positive note. In 2024, investors saw the last 3 of 8 Fed meetings produce interest rate reductions. However, the Fed's meeting notes from 2024 suggested that 2025 would probably start with a pause. After starting the year with a range of 5.25% to 5.5%, the Fed ended the year with their key rate at 4.25% to 4.5%. In their January 2025 meeting, they kept the federal funds rate at 4.25% to 4.5%. Remember that the Fed remains committed to achieving a 2% inflation rate goal. Therefore, interest rates and their direction in 2025 will still need to be watched. The Consumer Price Index is a key inflation gauge. While we've seen results from the Fed's aggressive campaign to lower inflation from its high of over 9% in June of 2022, it is still not at their 2% goal. For January 2024, the inflation rate was 3.4%, and December 2024's rate of 2.9% pleasantly surprised many. As reported in February, though, the inflation results for January 2025 showed a very slight uptick to 3% over 1 year. Although inflation is far better than it has been since it started to spike in 2021, it is currently still increasing prices and acting stubbornly. This may affect the timeline as to if or when interest rates continue to move downward. Now, as consumers, we feel price increases, and that's why inflation at high numbers is challenging. Anyone who walks through the grocery store is constantly reminded that prices of goods have risen over the last few years. Another way shows itself, especially in the grocery stores, is through shrinkflation. That is when the size of the package you purchase is smaller but is selling for the same price, or even smaller packages at a higher price. So as financial professionals, inflation is definitely something to watch. Now let's take a look at bonds in 2024. As you may remember, bonds and interest rates move in the opposite direction of one another. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Even though the Fed reduced the federal funds rate 3 times during the year, the interest rates on Treasury notes and bonds ended 2024 higher than they started. On December 31st of 2024, 5-year Treasury notes yielded 4.38%, 10-year notes yielded 4.58%, 20-year bonds yielded 4.86%, and 30-year bonds finished at 4.78%. As of February 14th of this year, rates were similar to the December rates, just slightly higher. Now, one of the keys to bond investing that we want to highlight is that if you own the actual bond, even though your bond's value may fluctuate as interest rates change, being able to hold on to your bond to maturity where the bond pays at a par value keeps bond investments at lower risk compared to other investments that often do not have the guarantee of value known at maturity. We continue to closely monitor interest rate movements. With a current forecast of future Fed interest rate cuts to be paused, there could be some opportunities to find some lower risk, higher yielding bonds. Safety comes with a cost, and even though interest rates have risen, many major banks are still averaging low interest and CD rates for savers. Interest rates offered by the banks on their accounts have typically come down though. Now we find that after deducting out taxes and inflation, most bank accounts show negative real rates of return, what we refer to as going broke safely. And for anyone who's interested in exploring better interest rate options, please contact our office. So as we enter 2025, we are excited about the turns 2024 brought and have reasons to be optimistic. But there are still some major issues that need to be watched carefully. Inflation and interest rates will continue to be two of the top factors that will affect the direction of the economy and equities. Other issues that could affect the direction of equity markets include the new administration in Washington. This new administration talked about making changes to tax laws and possibly using tariffs to affect trade in other countries. Please remember that changes in tax laws can take time, and sometimes they do not go into effect immediately. International tensions abound. We are still seeing continuing geopolitical unrest in the Middle East. There is still the ongoing Russia-Ukraine war. Tensions with China will also remain a concern. The global economy will also continue to be a concern in 2025. Equities do not like geopolitical or global economic uncertainty, so we will continue to keep an eye on how they may affect the equity markets. And as your financial professionals, we are committed to keeping you apprised of any changes in activities that could directly affect you and your unique situation. So watch out for our emails. So what has historically happened to equities when the Fed moves rates? Now let's remember that the Federal Reserve was created in 1913 as a response to the banking panic of that time. Their central purpose was to uphold what is referred to as dual mandate. That is to maximize employment and stabilize prices, which essentially means to keep inflation in check. Now they're scheduled to meet 8 times this year. At their January session, they paused moving rates and indicated that this pause may be for the near future as well. Investors will have to wait and see if they will continue to reduce interest rates during meetings later this year. Now, the results of the Fed's meetings and discussions always present the possibility of immediate temporary equity market movements. And if that happens, investors should try not to overreact. Now, equities primarily respond to corporate earnings. In 2024, corporate earnings reports for the most part were healthy, and starting in 2025, a majority of companies have already reported earnings that are showing growth. This is good for the economy and one of the reasons why the equity markets have done well. Now, one of our goals as financial professionals is to keep monitoring these results so we can advise our clients moving forward. Now, to take us forward, allow me to bring up Will Glenn. Will?
Thank you, Manny. One of our primary goals is to help our clients make more informed financial decisions, which could lead to better outcomes. So let's take a few minutes to go over some key 2025 items to look out for. 2023 and 2024 rewarded long-term investors, and 2025 has started on a healthy note. We continue to follow the understanding that investing in equities is a long-term commitment, and we are still recommending equities as a long-term investment. We know we cannot time markets. We have never found anyone who can. Just because returns have done well, this is not the time to become complacent or make risky decisions. Heading into a new year, we believe that volatility could still be prevalent and that investors should be cautionary when making financial decisions. Again, a long-term strategy and measurement needs to continue to be the benchmark for smart investors. Markets have enjoyed strong annual equity returns in 2023 and 2024, both up over 20% compared with a long-run average of about 10%. History teaches us that after that kind of run, we need to be prepared for a possible pullback. Also, valuations of some leading equities are historically high, which is another indicator that it could be possible that equities pull back during 2025. Having said that, market momentum is high, and long-term investors never want to be caught trying to time equity markets. Currently, we're still enjoying a rising market, or what we like to refer to as a bull market. However, when the S&P index falls more than 10% from a recent high point, it is said to have entered correction territory. There have been 24 market corrections since November 1974. They historically happen on average about every 18 months. The term correction is used because historically, the market drop often corrects and returns equity prices to their longer-term trend at some point. The S&P 500 did not experience a correction in 2024. Analysts say that corrections are healthy and even necessary for bull markets. They help shake out some of the so-called froth in the stock market, where prices usually run up dramatically and get ahead of themselves. Analysts are also sharing that a correction isn't necessarily something to dread. Many strategists are still predicting solid earnings growth for equities in 2025. With that backdrop, stocks could head higher, even if there are some bumps in the road. We're only sharing this as a way to alert you that if you do see equities drop, do not panic. Should this happen and you get concerned, your first move should be to call us. We all get emotional at some point, and it helps to have a steadying hand there to help you get through the inevitable downturns. So what else should investors be looking at in 2025? Inflation is near 3%, not the Fed's desired 2% goal. Because of this, look for possible interest rate stagnation. The Fed may not lower interest rates for a while. The economy and many economic indicators like corporate earnings and unemployment are still showing signs of strength. The return of equity market volatility can unnerve even the savviest of investors. Having a solid investment strategy is an integral part of a well-devised, holistic financial plan. Remember, we help clients create a well-crafted plan customized for their unique situation and goals. We consider many variables, including your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. Most importantly, as always, we are here for you. As stewards of your wealth, we are here to help you pursue your goals. Let's talk about proactive tax planning. We feel it is important to remember that proactive tax planning should always be a key focus when reviewing your financial situation. We believe that a proactive approach to looking at your tax situation can lead to better results than a reactive approach. Tax laws seem to always be changing. 2025 looks like it could be a year for major changes for tax laws. One of our goals is to point out as many tax-saving opportunities and strategies as possible for our clients. Let's briefly review some broad tax information and some potential tax reduction ideas based on current laws. One of our goals is to continually educate our clients. Please read our special tax report, or if you do not have a copy, we encourage you to request one or visit our website and read it there. It offers valuable and useful information for filing your 2024 taxes, as well as proactive tax planning for 2025. Please connect with our office and we can send this report to you or anyone you feel may benefit from this information. Please remember that not all ideas may be appropriate for your personal situation. This is it for informational purposes only, and we always recommend you always address any tax strategy with a tax knowledgeable professional. The IRS has already released 2025 tax brackets. There are still 7 federal tax income brackets, which have been slightly adjusted from 2024. Long-term capital gains are still currently scheduled at favorable rates for 2025. Planning for retirement is always helpful. In fact, it's never too early in the year to start contributing to your retirement plan. Here are the current retirement plan contribution limits. Some has increased for 2025. Also, for those aged 60 to 63, there is a new super catch-up provision for your 401k plans. If you are 60 to 63, this is a great time to check with us as your eligibility to use this new rule. At these ages only, you can get the super catch-up of $11,500 instead of the normal over age 50 catch-up of $7,500. An additional $4,000 contribution limit. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of annual exclusion gifts. For 2025, the maximum amount of gift tax exemption is now $19,000 per person. For example, a husband and wife can give a combined amount of up to $38,000 to a family member without having to pay a gift tax or even file a gift tax return. Some other ideas for using this annual gifting can include contributing to an IRA for a working child or grandchild, or gifting to a 529 plan, which is a tax-sheltered plan for educational expenses. The Tax Cuts and Jobs Act, TCJA bill, was signed into law in December of 2017. Most of the changes that were made in this bill are scheduled to expire on December 31st, 2025. As you know from our discussions on this from last year, we felt that the only way the sunsetting would not take effect is if there was a Republican Senate, a Republican Congress, and a Republican president. Well, guess what we got? Yes, the trifecta. The current administration ran with the intention of extending these tax laws and making modifications. As of today, the sunsetting of these changes is still intact. This is a subject we anticipate having a lot of communication with clients and friends as we see what Congress actually passes. The original Secure Act changed the required minimum distribution age from age 70 and a half to age 72. Then, the Secure 2.0 Act pushed that age up even further to age 73. At this point, minimum IRA and pension distributions are required to be paid out by April 1st of the year after you reach age 73. This legislation also set the RMD age to increase to age 75 in the year 2032. Let's make this a little easier for you. If you are age 73 or older now, you need to be taking your RMD. If you were born in 1960 or later, you do not need to start your RMD until you turn age 75. I hope that is easier for everyone to follow. In addition to some catch-up contribution allowances for pensions, as we just discussed, another nice feature of the Secure 2.0 Act is the option to convert unused 529 plan funds into a Roth IRA for the benefit of the 529 plan beneficiary. The qualifications for this are a little complicated, including that the 529 plan must have been in existence for 15 years or longer. After 15 years, any 529 plan assets can be rolled into a Roth IRA for the beneficiary, subject to the annual Roth contribution limits and an aggregate lifetime limit of $35,000. This rollover will be treated as a contribution towards that person's annual Roth contribution limit. If you would like to see how this fits into your situation, please schedule a time to talk with us. To finish things up, let me bring up Brent Beverly. Brent?
Thank you, Will. That was well done. As we mentioned earlier, it's important to be proactive. So let's look at some more helpful proactive tax planning strategies, this time looking across family brackets. A critical area to review in tax planning for your retirement accounts is what we refer to as overall family tax bracket management. So if you have retirement assets that are not in a Roth IRA, when and who takes distributions from those plans can make a huge financial difference from a tax standpoint for your family. So simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to wait, take out the minimum you can take, and let the beneficiaries take the distributions in their tax bracket rather than you in your higher tax bracket. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take those distributions in your bracket now, and if possible, convert these accounts to Roth IRAs, then leave your beneficiaries an account that, while it still must be taken out within 10 years after your passing, can grow tax-free for all of your life plus up to those 10 years. That can be a lot of tax-free growth. Now, a key step we like to start with is to help clients look at tax minimization. And so we need to compare your marginal tax rate with your beneficiaries' marginal tax rates each year. This is something we try to think about for our clients, especially those with large retirement accounts. A good way to avoid paying the tax at your tax bracket is to pass it on to your heirs and is to look at doing a Roth IRA conversion. Especially now with the Secure Act's 10-year rule, for some people exploring a Roth IRA conversion could be helpful. Some benefits from a Roth IRA conversion include they can lower your overall tax income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs, which currently, as Chris noted, is at age 73. And Roth IRAs allow tax-free withdrawals for your beneficiary. Now, partial or full Roth IRA conversions are not for everyone. Whether you convert part or all of your traditional IRA to a Roth IRA depends on your specific situation. So before doing so, it's best to prepare a tax projection and calculate the appropriate amounts to convert each year. As with many financial decisions, there are several pros and cons to making this change. So call us or talk with your tax advisor to see if this might make sense for you. For those of us who are close to the standard deduction level each year with our Schedule A deductions, a strategy to consider is bunching your charitable donations into a donor-advised fund. For example, somebody who's slightly over the standard deduction each year can bunch 3 years of charitable deductions into one contribution to a donor-advised fund. This could bring that taxpayer a much larger overall tax savings over, in this example, 3 years. Then from the donor advised fund, they can give their favorite charity money each year, same as what they were doing. But this works really well if you have appreciated assets like stock. Gift the unsold stocks into the donor advised fund, which can then sell them completely tax-free, and then follow your advice to make your donations from the donor advised fund to your favorite charities each year. Now is the time to explore this if it's helpful for your tax situation to deposit cash, appreciated securities, or other assets into a donor advised fund and then distribute the money to charities over time as you direct. Now, for more information on this strategy, again, talk to your advisors, give us a call, talk to your tax advisor, see if it works for you. Another strategy to look at is the qualified charitable distributions, or QCDs. Right? A QCD can be a tax advantaged gifting strategy for retirement savers, particularly those with larger plans. Now for 2025, the maximum QCD, the maximum qualified charitable distribution, is $108,000 per individual. Now that's the maximum. You don't have to do all that. But what this means is that someone age 70 and a half or older, now note that age, 70 and a half. This is the earlier age for RMDs. Age 70 and a half can donate up to $108,000 each year directly from their IRA to a qualified charity without having to include that amount in their taxable income. So one idea that experts suggest, especially if you're charitably inclined, is to consider using part or all of your RMD once you're over that age 73 for a qualified charitable donation, a distribution, a QCD. If your charitable contribution is not helping your tax deductions, why not pay it with your IRA? Your charity gets the same funds and you get a tax advantage. Everyone wins. Now, like many of the other strategies we're discussing today, again, see us, see your professional to help you do that. The new administration in Washington ran for office with the goal of changing the tax laws. Part of their discussion was to continue the favorable rates that we've seen since 2017. Another part was to make changes. Our goal today is not to speculate on what or when, but to watch and learn. We want to help our clients when these changes actually come about. We don't control the changes. Don't look at us, we're just the messenger. We don't control the changes, we don't control the tax laws for that matter. Our goal is simply to help you understand the laws and use them to your best advantage. So during the course of this year, please be prepared to hear from us on the changes and the opportunities as they take place. We appreciate you, and your best compliment is a referral. We're very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. We look forward to serving you in 2025 and beyond. So the best compliment that you can do is to help us work with other people who can use our services. Some of our best clients were referred to us by existing clients. If you know someone you think may benefit from our service, we would appreciate their contact information so that we can add them to our distribution list to receive our newsletters and so that we can invite them to attend our presentations during the year. Now, we're having a couple of in-person seminars this year. These are very good for your friends to attend with you. Next month, we have a webinar presentation on avoiding scams. Now, we recommend this presentation for everyone. If you're not worried about falling victim to a scam or cybercrime, you probably don't know what is happening in the world today. Be sure to attend and to share that with family and friends. Please trust us in this. They need to hear this. You need to hear this. We started out thinking it was pretty easy and ended up scared to death. So if we're worried, you should be worried. So again, thank you for working with us and watching this. As you know, our primary goal is to keep our clients informed, and we appreciate you watching this. We recommend that you pause this now and read through the disclosures that we have here. We're thankful that you took this opportunity. We appreciate the ability and the opportunity to assist our clients with your financial needs. At our firm, clients come first. Our client health and well-being is always our first priority. One of our major advantages as a financial advisory firm is the advisory group's team, what we refer to as our TAG team. Now, we've included information for you to reach us. We're hopeful that you find this presentation helpful. If you have any questions, please reach out to us. We'd love to help you. We hope you enjoyed the presentation. Have a great year, happy, healthy, and prosperous. This concludes our presentation today.